Hello everyone, hope you are doing well. It's me Fahad, your ACCA tutor for financial management. So today we would be discussing an investment appraisal question. It's a past paper question. Okay, let's continue. So Charm Company, it's a software company, has developed a new game, Fingo, which plans to launch in near future. Sales of the new game are expected to grow very strongly. Following a favorable review by the popular PC magazines, Charm Company has been informed that the review will give the game a best buy recommendation. The sales volume, production volume, and the selling price of it 4 year. Sir, which means it's an investment project for 4 years in which year 1, year 2, year 3, and year 4, which of the data are given. The selling units, how many units would be it produce? It would produce 150,000 units, 70,000 units, 60,000 units, and 60,000 units. And the selling price for the first year would be 25, selling price for the second year would be 24, selling price for the third year would be 23, and selling price for the fourth year would be 22. Okay, sir. Then moving forward, financial information on the Fingo for the first year of the production would be as follows. So the direct material of Fingo would be 5.4 per unit, and the variable cost of production would be 6 per unit, and the fixed cost of production would be 4 per unit. Sir, when you would be given fixed cost per unit, then you would always calculate the fixed cost on the basis of the budgeted units. If there is no budgeted units, then you would always take your first year number of production or number of units, first year units as budgeted units. So because this is a fixed cost, and the fixed cost as the budgeted units would be the fixed unit, and if there's a change in the production, then it would be goes into the variable unit. Instead of the variable units, we would kept it as a fixed unit. Okay. Then moving forward, we have given the question has given us the direct material cost, the variable production cost, and the fixed cost. We have done with the fixed cost, and we have listened that the fixed cost would be multiplied with the first year production if there is no budgeted units given the question paper. So in here Charm Company there is no budgeted units given, so we will take our first year units as a budgeted unit. Then advertisement cost to simulate the demand are expected to be, sorry, the advertisement cost, there is advertisement cost which is expected to be 650,000 in the first year of the production and 1 lakh in the second year of the production. No advertisement costs are expected to be, there would be no advertisement cost in the third year and the fourth year of the production. Fixed costs represent the incremental cash, fixed production overhead. So as we know, we will always take all the relevant cash flows and ignore irrelevant cash flows. So what are the relevant cash flows which are important for our production, uh, which are most important that we will consider in our investment project. These are the relevant cash flows. Although the machine production has have an expected useful life, Fingo will produce a new production machine costing, so its working capital would be 8 lakh, the machine would cost 8 lakh. Although this production of the machine is expected to have a useful life of 10 years, sir, machine have a useful life of 10 years, but we are assessing a project on the basis of its 4 year, then we will consider the useful life of a machine as 4 year. Sir, why we would consider the useful life of the machine 4 year instead of 5 year or instead of 10 year? Sir, because only 4 years are relevant for us. After 4 years, if the machine has a life after 4 years, it would be irrelevant for me because I am appraising the project only for the 4 years. Okay, then moving forward, uh, government legislation allow Charm Company to claim the capital cost allowance of the machine against the manufacturing of the single product. Capital allowance can be claimed on the basis of straight line basis over 4 years. Sir, it's mean that the government has allowed us to get the tax benefit on the basis of depreciation, because depreciation it's our accounting expense, is not the tax, not the expense in the views of the tax authorities. Therefore, we would get the tax depreciation as a benefit. Charm company pay tax on the rate of 30% per year, and the tax liability would be settled in the year in which it would arise. In the year in which we had incurred the profit, we will always give tax in that year because it is given in the question. The tax liabilities are settled in the year in which it is arise. Okay, then moving forward, Charm company also uses the tax discount rate. Sir, it is our discount rate, cost of capital. It's 10%. Sir, cost of capital is equals to 10%. Then when appraising a new capital investment, ignore inflation. As we knew, there is no inflation rate given, then we will always ignore inflation. Otherwise, it is also given in the question that you have to ignore the inflation. Okay, then we have three parts of the question. Part number one, it's calculate the net present value of the proposed investment and comment on your finding. We have to calculate the net present value of the project and comment whether it would be feasible to accept the project or reject the project. And part B, we have to calculate the internal rate of return of the investment project and comment that whether it is viable to accept the project or the percentage we are getting it's viable to accept it or reject it or ignore it. In the part number C, discuss the reasons that why the net present value of the investment project is preferred to the other investment appraisal such as payback, return on capital employed and initial rate of return. Sir, you have to discuss that why your discounted cash flow, or why you always consider your discounted cash flow instead of your non-discounted cash flows, because non-discounted cash flows does not consider the time value of money, and discounted cash flows consider the time value of money, that such as your investment appraisal, your net present value. Uh, Sir, all you have, for example, your payback period is a non-discounted cash flow. Your accounting rate of return is a non-discounted cash flow. Therefore, you only consider your discounted cash flow, which are your net present value and your internal rate of return, because sir, these consider time value of money. Sir, we will discuss theoretically when we will reach at part number C. Firstly, I think we should continue part A and part B. Okay, sir. You guys please read the question, then we will move forward. I think you guys have read the question. It's time to move forward. Okay. I think I should start the question from here. Okay, sir. Be careful and attentive. We have number of years. We have so we have 4 year project, year 0, year 1, year 2, year 3, and year 4. Okay, sir. Then the units, how many units does we have in year 1? In year 1, sir, we would be having 1,50,000 units. And year 2, we would be having 70,000 units. And year 3, we would be having 60,000 units. And year 4, we would be having 60,000 units. The selling price, the selling, uh, I think I should conclude it's directly rather than indirect. The sales for the first year is as follows. We have given the rate for the first year is 25 into number of units. It would be 3,750,000 for the first year. Then the second year is 24 into 70,000. It would be 1,680,000. In the third year, 23. The selling price per unit is 23, and we have 60,000 units. It would be 1,380,000. Then similarly, for the fourth year is 22 per unit, and we have 60,000 units that we have sold yet. So it would be 1,320,000. Then moving forward, we have material. Then we would be at variable overhead. Then It's come our contribution margin. Then it's fixed cost. Advertisement expenses are it's also our fixed cost. Okay, sir. Uh, we have material at a cost of 5.4 into number of units, sir. We have 150,000 units. Similarly, we will copy this and paste in each of the section. Sir, we have 5.4 material cost 5.4 per unit and number of unit into 70,000 multiplied 5.4 into number of unit 60,000, 5.4 into number of unit 60,000. Similarly, sir, our variable overhead would be 6 per unit into number of units, it would be 150,000, it is 9 lakh. Then similarly, we would add 420 in the second year, 360 in the third year, and 360 in the third year. Then after adding up all, our contribution margin would be 2040,000 for the first year, and for 4 year it would be 8882000 for the second year, 696,000 for the third year, and 666,000 for the fourth year. Okay, sir. Then our fixed cost would be, as you know, we would, if there is a fixed cost given in the question, for example, as per unit, we would always multiply per unit with our budgeted unit given the question. If there is no budgeted unit, no target unit given the question, that you would take your first year production as your target for your budgeted unit. So it would be a fixed cost would be same for each of the year. Uh, we have 4 per unit fixed cost, and number of units, our budgeted units would be 150,000. It is 6 lakhs for each of the year. So I would copy 6 lakh and paste it in each of the years. Then in question says that you would have the advertisement cost of 6 lakh 50,000 in the first year of production. We have 6 lakh 50,000. We have 6 lakh 50,000 in the first year, and 1 lakh in the second year. In the second year of production, then we would have no advertisement cost in the third year and in the fourth year. Okay, then moving forward, Pingo will produce on a new production machine cost. Okay, sir. It's a machine cost would be a working capital. I think we should place a working capital here. Working capital. Sir, our working capital would be 8 lakh rupees as given in the question. Okay. Then, although this production machine is expected to have a life of 10 years, government legislation of the capital cost of the machine, single manufacturing capital allowance would be given on the basis of baseline. Okay, sir, then we will be having our operating profit. Our operating profit would be at contribution margin in less fixed cost and then advertisement cost. Therefore, our contribution margin would be 7,90,000 in the first year, 182,000 in the second year, 96,000 and 36,000 in the third and the fourth year. Then we would calculate the tax amount paid. So we would be paying tax at the rate of 30% in the year in which it would arise. Sir, our operating profit of 7,90,000 operate in the first year. Then we would always pay tax in the first year only. First year profit, we would pay tax in the first year. In the second year, tax would be paid on the basis of the second year profit, and the third year tax would be based on the basis of third year profit. For the first year we are having 7,90,000 profit, so we will be paying 30%. Similarly, for each year we would be paying for 54,600 for the second, 28,800 we would be paying tax for the third year, and 10,800 tax we would be paying for the fourth year. Then working capital, we will be having 8 lakh. Sir, actually, one thing I am forgetting. There is a capital allowance schedule. capital allowance schedule in which we have to place year, depreciation, then it's tax saving or tax benefits. It's tax saving or tax benefits. Okay, sir. It's year 1, year 2, year 3, year 4. Okay. Depreciate. It would be depreciated on the basis of straight line basis, and there is no अपना अपना salvage value or scrap value given the question. So we would assume the scrap value as 0. Okay, then we would be multiplying. It is 8 lakh. We have a life of 4 year. Our project life is 4 year. Therefore, we would kept as a project life of 4. Instead, we have a useful life of a machine 10, because after 4 years the machine would be useless. We are appraising the machine only for the investment project or the appraisal project of the 4th year. Therefore, the depreciation for the first year would be 2 lakh, and the second year would be 2 lakh. Similarly, for the third year would be 2 lakh, and the fourth year would be 2 lakh. And we would getting tax saving at the rate of 30% each year. So we would be multiplying 2 lakh into 30,000. It's 60,000 for the first year, 60 for the second, 60 for the third, and 60 for the fourth. Okay. I think I should place it over here. Okay, sir. Then we would get in tax benefit. I'm getting tax benefit of 60,000 in the first year, and similarly 60,000 in each of the year. Working capital, okay, there is working capital of 8 lakh. Then after adding up all, we would be getting net cash flows. Our net cash flows are rupees 8 lakh for the first year. Our net cash flows are 8 lakh for the first year, 6 lakh 13,000 for the second, and similarly after adding up all, we would get 187,000 for the second, 127,200 for the third, and 85,200 for the fourth year. Then we would use discount rate. Discount rate as given in the question is it is 10%. So there are two formats. Uh, the easiest one nearest to me is your cap is equals to, if it is 10%, so you would get 1 plus 10%, which means 1.1 bracket close raised to the power into minus 1. So instead of dividing it 1 divided by 1.1 raised to the power number of year, I preferred to use 1.1 raised to the power minus into number of year. For example, it's year 0, so it's 1. Then copying this formula after placing in each of the years, 0.9 discount rate for the year 2, year 1 is discount rate for the year 1 is 0.91, discount rate for the year 2 it's 0.83, for the third year is 0.75, and for the fourth year 0.68. Then our net present value after calculating multiplying with this would be, if you would multiply 0.1 into 8 lakh, it would be 8 lakh for the first year negative. Then after copying this, we would place in each of the year. It's 557,273 for the second, 154,876 for the third, and 95,567 for the third, and 58,193 for the fourth. Okay, so then our net present value total, our total net present value would be after summing each of the year. It's 65,909. Okay, sir. We have to comment on this. So I would write that since since we are having Since sir we are having positive NPV, positive net present value, therefore we should accept the project. Okay sir, hope you would understand our first net present value question. I would minimize it. Sir, it's our first question number one, part A, calculate the net present value. So we have calculated the net present value, which is 65,909, and since it is a positive NPV, so the project is viable and we should accept the project. Okay sir, I think you have copied question number part A. Then moving forward to question number then moving forward to part B of our question. Sir, we have to calculate the internal rate of return. Okay sir. For internal rate of return, you have to calculate. So it means that for internal rate, I would like to draw data over here. For example, sir, here. So your net cash flows were. I would just copy the numbers. Sir, your net cash flows for the year 0 was 8 lakh, for year 1 was 6.3, for year 2 it was 187, and for year 3 it's 127,200, and for year 4 it was 85,200. Then the discount rate, I assume, sir, for the discount rate, if there is a higher cost of capital, the lower would be the net present value. If there is a lower cost of capital, the higher would be the capital. It is inverse proportional relationship. So I'm assuming, for example, there is a discount rate of 20%. For discount rate of 20%, I would have, what NPV would I would having? Sir, I would having the NPV of, for example, 1 plus I as I told you earlier, 1 plus 20% raised to the power minus number of years is it is, then copying to each year. So similarly, 1 plus 2, 1.2 raised to the power 2, 1.2 raised to the power 3, 1.2 raised to the power minus 4. After multiplying our net cash flows with the discount rate of 20%, we would having the net present value of 8 lakh for the first year, and similarly 510,833 for the second, 130,139 for the second, 73,611 for the third, and 410,888 for the fourth. Then adding up the net present value, we would be getting, sir, negative 44,329 and 3. If I would meet a table over here, sir, our small a would be the percentage of a positive NPV. So just remember this, that small a would be the percentage of positive NPV, which means that at 10% we was having a positive NPV of 65909. At point B is the rate at which we would giving the negative NPV. Capital A is the rate of capital A. Our positive NPV was 65909, and capital B represent at D 20%. We would giving the negative NPV was 44. So, sir, our formula is internal internal rate of return is equals to minus, wait a minute sir, sir our internal rate of formula is small a plus capital A bracket capital A divided by capital A minus B into small v minus a. So I would calculate it in its parts. Firstly, I would subtract a minus b, which means that RA is 65909. I subtracted with minus 44329, which means minus minus plus. 65909 would be added with 44329. It would be 110327. Then I would be dividing capital A I would be dividing uh, with our answer, which means that A minus B. So what is A? The A is 65909. It would be divided with 110273, which means it's coming point, which is 0.6. Then sir, what does our formula say? Our formula say that into B minus the answer is multiplied with B minus A. So B minus A, it means it is 0.6 is multiplied with B. So B would be 20% minus A, 20 minus 10 would be 10%. So I would directly multiply with A, which means 10%. So after 0.6 multiply by 10, it means 0.06. Then adding A, then adding small a in the above answer. Then adding small a in the above answer, which means 0.6. 0.06 has been added with 10%. So after calculating in percentage, our internal rate of return is 15.98%. Sir, our internal rate of return is 15.98%. Sir, it is our part B. Sir, our part B, you have to calculate your internal rate of return. So I have calculated our internal rate of return of the 4-year investment project. So the internal rate of return is 15.98%. So sir, you have to comment on it whether you have to accept the project or reject the project. Sir, on the basis of internal rate of return, we have came to a decision that we should accept the project because sir, our internal rate of return, sir, IRR is greater, sir, our IRR is greater than our cost of capital, that is 10%. Sir, I think that we should accept the project on the basis of our internal rate of return is greater than our cost of capital, which means our internal rate of return of 15.98% is greater than our cost of capital of 10%, which means that your 15% is greater than 10%. So you should accept the project. It is viable for you to make investment in the 4-year appraisal project. Hopefully, sir, you have understand our part number 2. Then moving forward to part 3. Sir, in part 3, you have to discuss the reason that why net present value appraisal method is preferred on an investment appraisal method such as is preferred to another investment appraisal method such as payback period. So simply you have to write that your net present value, so your net present value method is preferred more than your other methods, such as, sir, your net present value method is preferred more than your other method, such as your payback period, return on capital employed, and internal rate of return. Payback period, internal rate of return, and sir, and your uh, return on capital employed, return on capital employed, which is also known as your accounting. Okay, sir. Question asked that why your net present value method is preferred more than your other methods, such as your payback period, your net investment method, and your accounting rate of return. Sir, uh, your net present value method is preferred more than your accounting rate of return, your payback period, and on return on capital employed, just because net present value method is a discounted cash flow method. It considers time value of money, whereas payback period and return on capital employed mean accounting rate of return is a non-discounted cash flow method. It does not consider time value of money. There are various reasons that you can justify your answer, such as sir, accounting rate of return. You can manipulate. It is based on your accounting profit, and you can manipulate your accounting profit, but your net present value, it is based on your discounted cash flow method. It consider time value of money, the actual value that you would get after 4 year investment project. So sir, there are various reasons that you can write and you can define or you can justify your answer with this. I just tell you the brief overview, a small intro that why you should focus on your discounted cash flow instead of your non-discounted cash flow method. Hopefully, sir, you would understand question number one of our investment appraisal project, that was Charm Company. If you have any query, you can also comment me or WhatsApp me. Okay, sir. Thank you. Allah Hafiz.